Hello everyone. Today we'll be learning about options price decay and how we can actually trade options. But before we dive into that, let me reiterate the basics of call and put options. So a put option is basically a contract that gives the holder, the buyer of the put option, a right to sell the share at the given strike price at the time of expiry. While on the contrary, the call option is basically a contract that gives the buyer the right to buy the same share at the given strike price at the time of expiry. So let's take an example. So for example, this put option of strike price 18,000 is worth 22.75 rupees. So the buyer will be paying 22.75 rupees and will get a right to sell the share at 18,000 rupees at the time of expiry. So the expiry for Nifty 50 options is Thursday of every week. And so if the market goes down to 17,000, the buyer of this option will be honoring the contract because he or she has the right to sell the share at 18,000, and then that person can buy it back at 17,000 rupees, hence making a profit of about 1,000 rupees. And while on the other hand, in case of call options, let's say that that someone buys this call option at 32.75 rupees for the strike price of 18,500, and the market goes up to 19,500. So that's when the buyer of the call option will be exercising the right to basically buy the share, because that would lead to an instant profit of about rupees 1,000. So now let's understand what is options price decay. So as I mentioned that the expiry for a Nifty 50 options is every Thursday. For example, uh, today is 18 December and the next Thursday is 22nd December. So the expiry will be on 22nd December, which is Thursday. So now let's assume that the market is at 18,269 at about 1 to 2 minutes before expiry. So let's say it's about 3:28 or 3:29 p.m. And in 1 to 2 minutes, the market is about to close. Basically, these options will expire. So now if there is a put option buyer, someone who is interested in buying a put option, will he or she be going for buying a put option which has a strike price of 18,000? They won't, because we don't expect the market to fall down to 250 260 points in the last 1 minute. That doesn't really happen. It may happen. I am not saying that it won't happen, but that doesn't really happen. So basically, the value of this option goes down to about very close to 0 rupees. And similarly, the value of all these options goes down. So that is what basically is options price decay. Similarly, in the case of call options, someone who is interested in buying a call option won't be buying an 18,500 strike price call option just 1 to 2 minutes before the expiry, because we don't expect the market to go up by 250 points either. So the value of these call options decay as well and come as close to zero, like it goes to about 0.05 rupees. And we can even confirm this theory of ours by seeing that as we go away from the market value, the price of the options decrease. because we don't expect, no one expects the market to go down that much. So let's say the market is currently at 18,269 rupees on Sunday, and we don't expect the market to go down to, let's say, about 16,000 rupees unless something really bad happens. So the market won't be going down till here. No one expects it. So that's why the price of this option is as low as 0.45 rupees. While the ones that are closer to the market, uh, which is let's say 18,250, are as high as 86 rupees. Or even if we look at the call prices, then they are as high as 99.3 rupees. So this is what basically is options decay, is basically that at the time, as we approach the time of expiry, the price of the options that are relatively far away from the actual market value goes down. So how do we actually trade in options? So now let's say that we are able to anticipate or predict that the market will be going up. Let's say that today is Wednesday, I expect the market to go up today. Now, if I expect the market to go up, I know that the price of the call options will increase. So what I can do is basically I can go ahead and buy one of the so let's say that I expect the market to expire on Thursday, that is tomorrow in our case. So I'm assuming that today is Wednesday. So and I expect the market to go up by about 500 points in 2 days and go to 18,700 rupees. So the if I buy the call option at 43.95 rupees right now, and the market actually goes up to 18,700 rupees, the price of this option will increase uh, to about 18,700 minus 18,450, which is close to 250. So from 43.95, it will go up to 250 rupees. So, giving me a profit of 200 rupees on one piece of option. Now, the it's actually a rule that in Nifty we can trade in options in lots of 50 pieces. So each lot has 50 pieces. So that would mean that if I buy this one lot of this call option, which would be close to about 2,100 rupees, I will be making a profit of about 10,000 rupees on this. So this is basically one way of trading options. And so the bigger question comes in is, how do we anticipate or predict where the market is going to go? Is it going to go up? Is it going to go down? How much exactly will it go up or down? So nobody can really predict the exact amount that the market is going to go up or going to go down. But instead, we there are several parameters which we can look at, and we can like have a calculated guess of where the market is expected to go. So in the next video, I will be talking about these parameters that we can use to have a calculated guess of how the market is going to go up or going to go down in the next, let's say, 1 day, 2 day, or even 1 week. Although it's not like I'm and saying it again and again, that it's not possible to predict the exact movement of market. It depends on a lot of factors, but we can still have a look at several different uh, of those parameters which are calculable and are available to us. So that would be it for this video, and thank you for watching.